Thank you.
Gentlelady yields. The gentleman from Wisconsin, Mr. Fitzgerald, is recognized.
Chairman, thanks for being here. There has been a lot of talk about Basel III. Wanted to just change that subject a little bit. Long-term debt proposal, I think, should be rewritten and reproposed as well. But at the very least, the rule needs to be tailored as law requires so that regional banks aren't treated more harshly than the largest banks, of course. In particular, the requirement for regional banks to hold long-term debt at both the holding company and insured depository institution, that seems to be a burden is what we're hearing, I think. I just wanted to mention that I would hope that there would be some flexibility for smaller regional banks to pre-position resources because they're obviously, there's some resources that are loss absorbing, I guess is the way you would consider them in the reproposal. Do you have any thoughts on kind of how this is playing out right now or what this looks like?
Yeah, so on the long-term debt thing, we put it out for comment. We've received quite a few comments, and staff has been analyzing them, and that's something we're well aware of the concerns that have been raised, and we're thinking carefully about how to move forward on that. The other one was pre-positioning. That's more along the lines of the discount window and the liquidity requirements, I take it. So
right.
So we haven't made a proposal there yet. We're thinking carefully about that. I think we're trying to learn the right lessons from what happened last spring at Silicon Valley Bank and a couple other banks, and one of them just is the discount window worked, but we could certainly modernize it, make it more effective. And also we learned, that bank runs are moving just a whole lot faster, at least in that case, and that even bank runs from 10 or 15 years ago were nothing like as fast as what happened in Silicon Valley. So we need to bake that new learning into the liquidity requirements in some way or other. We, again, haven't made a proposal. When we do, of course, it'll go out for comment, and we'll very much want to learn from those comments.
Very good. There's been a clear trend of banks stepping away from the mortgage market, kind of in the face of the increased regulation. That's my interpretation, at least. Non-bank lenders have stepped in to kind of fill that void. Today, banks support the non-bank lenders in the broader housing finance system through the so-called warehouse lending for home mortgages. But I'm deeply concerned that some of the, as was mentioned by my colleagues earlier, that some of the Basel rules could harm both bank and non-bank lenders alike, kind of undermining the liquidity and kind of the raising costs of home buyers. So let me just ask, in regards to Basel III, the endgame proposal, could it make housing finance less stable, I guess, is the question.
So that's certainly not the intention, and we're again well aware of the of the concerns that have been raised, and certainly paying careful attention to those.
Despite the smaller issuer exemption for the debit interchange fee cap, insurers with less than $10 billion of assets reportedly lost about 35% of inflation-adjusted interchange revenue. Have you considered the impact that further reduction of debt interchange will have on small financial institutions with less than $10 billion of assets?
Yes, so that's another one where we put out a proposal. We got a lot of comments, and we're carefully reviewing those, and you're certainly aware of the specific concern that you raised.
As you may know, the latest Fed Y14 proposal, which is used to help collect data for Fed stress tests, asks banks for more detailed data on bank lending to non-banks. As a result, there's concern that the Fed may start trying to indirectly regulate non-banks and the financial risk. I just talked to one this morning that's concerned about that. So given those concerns raised about the lack of transparency in its stress testing models and the potential unintended consequences, is the Fed planning to indirectly regulate non-bank financial institutions through these tests?
That's not the idea. The idea is we see intermediation growing very quickly in non-banks, and we don't regulate them. We don't have a secret plan to regulate them or anything like that. But the question is what risks are being kept inside the banking system, which we do regulate and supervise, and what are the relationships between these large non-banks and banks? And, we don't have a preconceived answer to that. We just want to understand what are those business relationships like, and what kind of risks does that mean the banks are running? That's all it is.
Thank you, Chairman. I yield back.